Hey, before we get started, I want to tell you about some bad actors out there. These are people that are trying to sell you annuities. Annuities just don't make sense for the investor. They make sense for the person selling it to you. They have tremendous commissions. They also make sense for the company who created the annuity. Our advice for most annuities is to stay away, and that's simply because we are approaching financial planning from a fiduciary and fee-only standpoint, meaning that when we look at investments, we're trying to figure out what's best for the client, and most importantly, we don't sell product. People come to us to solve financial questions or problems or help set goals for the future. So when we break all this down, I don't know that in the history of our company we have ever recommended an annuity, simply because we don't have quotas. We don't have sales quotas to meet. Our quota is to make sure that each family that comes to us gets the best financial advice possible. The bad actors out there, a lot of times, are nice people, and you might know them from a church or baseball or something like that. It doesn't mean that they're bad people. It just means that they've drunk the Kool-Aid of their organization to sell products that don't work in the best interest of their clients. So stay away. If you want to learn more, you can go to our website at wiserinvestor.com. At the very bottom of our screen, we have buyer beware of the annuity salesman. Input your email, and you'll download our white paper on why you should avoid annuities. Thanks for listening. Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. It's my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey. How's it going?
It is going great. I am looking at a piece of paper right now with 1-year market returns. This is our weekly roundup, or quarterly roundup. Podcast. So we have a lot of clients dialing in after getting their statements and such. Hello, everybody. Man, I mean, S&P 500 over the last year up 57%. The small caps, that's the S&P 600, up 96% in 12 months. I think what we're capturing here is the bottom of the Corona crash.
Yes.
And now we're at the top end of the recovery. And you can slide your view of market performance anywhere you want to make it look really, really good or really, really bad. We're not trying to do that. We always go back a year. We just say, what have we done in the last 12 months? Brad, you're the all things investments here at Wiser Wealth Management, the investment guru. What say you?
Well, I say that this has been a fascinating time to be an investment professional in. I'm glad I got to do it. I hope we don't have to do it again, would be what I have to say. When you look at returns in the 50, 60, 90% range, something has gone very well to make those returns go that high, but it's caused by something that must have gone very bad at the beginning of the period. And then we know what that happened. That was the coronavirus shutdown. For some reason or other, we got this virus here in the U.S. and around the world, and everybody thought it'd be a good idea to cure the virus, but shut down the economy to do so. And when we did that, our stock markets here and around the world crashed deeply. We went down 34%, I believe, on the S&P in a very short period of time. But as we began working through all this and businesses became, they adapted to it and adopted new ways of delivering products and services to the consumers and to the people who use their products, they became back online and their returns started to go up, and investors began to recognize that there's more than one way to do business in this country. And America, being what it is, has the best business leaders in the world. They found a way to make money, And sure enough, the S&P 500 went up 57% from its lows in late March 2020. Small caps did even better, I think, Casey, as you'd said, 96% return. And these are stories that are heard around the world. International markets were up 51%. Emerging markets were up 59% in the last 12 months. Now, this is a quarterly review, so we should go back to a little bit more recent. And more recent are still very good returns. The S&P 500 is up 6% this first quarter. Now, in any normal consideration, this period of 6%, we'd take that every day. I'd love to see a 6% return quarter over quarter. Small caps tripled that, 18% return in one quarter. Small caps, we know, have that explosive capability of returns. They're more volatile, as we're seeing right here. It's 3 times the volatility in this one quarter. But we want to be invested in small caps at all times because you have this opportunity for tremendous outperformance relative to their big cap brethren. The interesting story that has occurred here is how growth style and value style investing has played out over the past 12 months. We know that in 2020, growth was having a tremendous run, led by big techs, who offered new products and services to businesses so that people could interact with them, buy their goods and services from a remote circumstance. They could send their workers to remote environments to work rather than bringing them into the office and thereby trying to avoid coronavirus. Big tech had a great year last year. It was up over 70% by itself. Now, tech has somewhat cooled a little bit, which means that as investors began looking around for other areas, they began to see value stocks as being undervalued, and they began putting money into that and boosting the returns on value. Value for the quarter was up 10%. For the past year, it was up 50%. Sometimes this is referred to as a reversion to the mean, where value stocks had been underperforming for quite some time. Growth stocks have had a tremendous run for the past several years. A reversion to the mean simply means that the returns become more averaged if relative to the past. So we're seeing that occurring right now in value. And what's in value? Things like energy, financials, industrials are often in value. And energy led the way this past quarter, having a wonderful return of 29% just in the past 3 months. As energy demand has grown, because as businesses come back online, people are doing more traveling, they're getting out, the requirement for energy has gone up, and sure, energy stock prices have followed suit. Financials are up 15%, industrials are up another 11%. This is occurring around the world. International markets were up 4% this past quarter. Emerging markets were also up 4%. We use international and emerging markets in our portfolios not only to have a non-correlated return stream to the domestic markets, but also to take advantage of any currency swings, that are offered through international investing. One of the things that we talk about around here is that by being core investors in ETFs, what that gives our investors the opportunity is to always be invested in the best performing sector. Very difficult to figure out which sector is going to outperform at any given time. I don't know that anybody ever really saw this energy phenomenon occurring, where energy stocks went up 29% in this past quarter. But given that we're invested in the ETF, the S&P 500, which invests in all 11 sectors, we had our clients invested in energy, proportionate to the S&P 500. All sectors were up this past quarter. All 11 S&P 500 sectors were positive for the quarter. It was just a great time to be investing. Matthews, what did you see?
Just to your point of ETFs, I thought it was interesting. Actually, a lot of the bottom 10 stocks in 2020 have actually been the leaders in the first quarter of 2021. You look at companies like Carnival. Last year, we're down over 56%. Last quarter, we're up 22%. United Airlines was down 50% last year, up 33% this year. American Airlines was down 44% and up over 51% last quarter. So these were companies that were cut in half last year during the bottom of the pandemic, which makes sense, as you mentioned, with the world closing. Nobody was flying at the time, but they've started to rebound significantly over the first quarter. So that's kind of been interesting to see with the travel and leisure as well starting to come back.
And that's going to be important because that sector, travel and leisure, employs a very, very large number of people. In the recent jobs report, the travel and leisure industry saw an increase, in the number of people that are being employed in that area, primarily in restaurants and bars, I guess. But when the resorts, start rehiring, hotels start rehiring as a result of demand, I think that we're going to see that sector do very, very well. I know that Carnival, being one of the cruise ships, they're talking about how to bring back passengers. And I think this is going to be huge for the economy.
It'll be interesting to see how the cruise ships work. I do see more people obviously get on a plane to go travel somewhere, but if they can figure out the cruise ships, that'd be interesting to see how that turns around as well.
Industrials, I'd mentioned they were up 11% over the quarter. The ISM, which is the Institute for Supply Management, reported numbers for this past month. They were up 4% at 65. So 65 is a reading that is assigned to the institute by the Institute of Supply Management, and they use a line of demarcation of 50. A reading over 50 is generally associated with an expansion in the economy, and a reading under 50 is a contraction or recession in the economy. A reading at 65 is the second highest reading since December of 1983. I mean, that's, a very high reading. In March of 2020, it was at 42. So in 12 months, it's gone from 42 to 65. It's very important for the economy to have a strong industrial sector. These are good paying jobs. They are part of the supply chain with a positive, return in the industrials. It gives all the other companies that feed into the sector, like the financials, et cetera, to do well as well. So, and dividends, my goodness, dividends at the height of the coronavirus economy were cut and slashed as companies were looking to save money. In this past quarter, 120 companies out of the S&P 500 increased their dividends. So about a quarter of the companies in the first quarter increased their dividends. And on average, 11% increase over the previous year. So we're seeing companies respond by sharing those profits with their shareholders.
When I look at all these numbers laid out here, I can't help but think all the people who panicked during the fallout in February and March and went to cash because, we never lived in a pandemic before, and
not Great Recession or Great Depression all over again.
Yeah, they really human nature kicks in. So, I understand why you have those emotions, right? But you also have to understand the big picture and the power of the Fed, power of the government to be able to, especially in the U.S., to be able to manipulate your currency to have almost any result that you want. I think there are repercussions for the 1.9 trillion plus another 0.9 trillion plus this new one that could be 5 trillion now. There are repercussions for that in the future, but the good news is we get to control our currency then too, right?
That's right.
And plus, in addition to all that sell-off, you also had to have a nasty political cycle, have a nice, nasty presidential election, right? At the very beginning of, before we even knew COVID was coming here, and that rhetoric was still there, obviously, even on Inauguration Day. So we've been through a lot, and I think we're probably going to go through worse things as we go forward, which could bring on more market volatility. But it's very interesting. I feel like that politics now are encompassing everything. I can't get a soda now without it being a political statement as to which soda I'm grabbing. Maybe which airline. I just want to get there nonstop. Give me the nonstop flight, please. Right? It's as we evolve with business, and now, Coke and Delta are in the background, evidently lobbying for a voting bill, which in my opinion, they have no business in there doing that. But that's the modern corporations. They want to take their own agendas and make sure they're putting that into politics. But what it comes down to is we see a lot of negative statements. Oh, this current administration is going to make the market crash. They're going to take away all of our 401k plans. They're going to do all of these things. And a lot of it, honestly, is just fear. They're using fear to motivate their political agenda. What I like to do is look at Vanguard, BlackRock, State Street. Those are three reputable companies, right? We know BlackRock's really big on their ESG, and I forgive them for that for right now. You listen to our ESG podcast on that one. But I'll look at these projections, and in front of me now I have a Vanguard projection for 2021. There's not one company out there right now that is saying that the stock market is due for a major crash in 2021. But if you go and listen to certain political news, it's doomsday, right? So we have to separate emotions and how we feel about politics from our portfolios. Those have to be two separate things. We can't mix politics and money. That's a bad combination. And so looking at market perspectives for this year, we've got a pretty good look at the U.S. and we do have a rise in COVID cases again. I think some people are probably letting their guard down. Also, some states are opening up for the first time. Imagine that. But we have a lot of positive momentum. We have a client with a business in California. California is supposed to be still shut down, but he's saying restaurants are opening anyway, just defying government orders and saying, we're open. What are you going to do? Because people are tired of being suppressed. People are tired of being told that they can't go out and do their craft and make their money, right? We have bookings at airlines at record paces, where even Delta now has decided to sell the middle seat going forward, right? We have cruise lines, which I don't think will open up till after their busy, what normally be their busy season.
I expected in the third quarter of this year, I believe.
Yeah, they've definitely been hit pretty hard. But we're starting to see bookings. Disney's at capacity. It's a reduced capacity, but is at capacity. So there are a lot of positive things to be looking at in this market. The market will do things despite politicians, despite what they do. They might react negatively initially to the news, but in the end, Coke is in the business of selling soda. Delta's in the business of getting you from point A to point B. And they're all trying to deliver value to their shareholders. And that's what we have to focus on. Thank you for listening to our podcast. We really appreciate all the feedback we've been getting from our listeners on future topics and the That A Boy emails. We really appreciate that. We see listeners growing every single week, and that's fun for us, and we enjoy doing this. If you could take a minute, depending on how you listen to the podcast, if you go to Spotify or Apple Podcast, and you could rate our podcast a 5-star podcast, that'll help us in the rankings. We continue to climb up each week in the number of listeners, as well as the response on the feedback online. And then we've also started a YouTube channel. If you go to YouTube, you type in Wiser Wealth Management, you can find the weekly roundup, which is a video between myself and Brad, or myself and Matthews each week, just talking about some of the various topics that we've seen and some interesting thoughts we might have on those. Again, thank you for listening. Please give us positive feedback online. Help us grow the brand. Thank you.
Mentioned with everything going on, we're actually at an all-time high in the markets, and there's been 15 all-time highs this year alone. So there's been a lot going on, and it's still been trucking along. So kind of, like you said, got to learn to separate the emotion as well as the politics and everything else involved.
Yeah, I mean, no one sees the Fed raising interest rates. That would slow things down. Everyone thinks the unemployment rates will keep getting better and better going forward. I see how one signs everywhere. I think once they stop paying people to stay at home, then eventually those people go, well, I got to pay my rent and I got to get a job, and maybe those signs start to go away. But it's almost, you can make the case that there's too much stimulus, which means the market's going to get really hot with too much stimulus in place.
Well, with these direct stimulus payments that have gone out in the past 12 months, the most recent one being $1,400 per individual or qualifying individual. And you add to that the $600 that was approved like on December 29th, started going out in early January. In this quarter alone, we're looking at $2,000 of direct stimulus payments to families. And then you add to that the $1,200 that went out shortly after the coronavirus hit. And we're looking at $3,200 per qualifying person of money that's gone into the system. And you add all this up, and it's over $500 million. It's over, it's over $500 billion. It's $585 billion of direct stimulus payments that went out to individuals who had the freedom, the ability to spend that however they needed. Some people used it to pay their bills. Great. Some people used it to buy other things or to save it. And if they saved it, it's just pent up demand. So there's a lot of money sloshing around out there.
I think the only concern I have is the Fed is proven to be unable to stop the extremes. We got interest rates too low for a while, right? Heated things up too much. Now we have inflation that's expected to be 2% this year. I think that's probably the highest it's been in decades.
In many years. Over the past 10 years, it had averaged 1.6%.
So they don't catch
extremely low.
If they don't catch the tail end of that, right? If they don't put that stopper on it, that could be a problem if we end up with 4, 5, 6% inflation in a year or 2 years. Inflation's good though overall, but that's certainly why you'd want to favor stocks inside a portfolio over bonds. But that doesn't mean we sell our bonds. We still have to have bonds in a portfolio to help with volatility. Those bonds, even though the rate of return might be negative this year or over the last 3 months, it's still an important part of your portfolio. If your stock portfolio is up 80% in the last year and your bonds are down 3%, who cares, right? Because when it flips, you need those bonds in the portfolio. I think it's foolish to be wanting to sell bonds to buy more stock at this point.
Well, this time last year, that's when we rebalanced. Bonds had done well, and we bought more stocks that had dropped. The bond market, actually, treasuries at least, had the worst quarter in over 40 years, quarter 2021.
Right.
So that's a big reversal in a year. So
yeah. Well, that's the beauty of Brad here guiding the investment management ship for us, because we got a great rebalance in at the bottom of COVID, another rebalance in
just recently
at the rebound,
yeah,
and then recently another rebalance this last quarter, I guess last week actually, that captured again the gains in stock and put those back in bonds at lower prices.
That's right. So again, speaking of bonds, when you're investing in bonds now, you're buying at low valuations. And keep in mind also that, bond managers, even in index funds, bond managers are constantly buying new issues. So if interest rates are creeping up a bit, they're buying it, bonds at a little bit of higher interest rate. If rates do rise over time, they'll simply be buying bonds then that have a higher interest rate, raising the yield that on our investments. And these bonds, since we buy all investment grade bonds, they all mature at par. We're not going to lose any money.
Right.
Right. So bonds are a great investment. They're needed in a portfolio, and we're going to keep them.
Yeah. Well, it won't go to zero. I guess potentially you still could lose money if you bought it at a premium and then it matured at par, right? But then you're taking that money, you're buying back something at a higher yield.
Something else at a higher yield.
Yeah. I remember being really worried about this during the financial crisis, during the rebound. Back then we determined it was 7 years. It takes about 7 years for it to kind of work through the aggregate bond portfolio. The good news is here we don't use the aggregate. We have our own custom index that we're using for that. So so we can shorten that 7-year period.
That's right. We want to shorten the duration to avoid exposing the bond portfolio to higher interest rates.
Yeah. Well, I think another thing you have to be careful about too is the opposite of selling when things are really bad. It's buying more stock when things are really good. And I don't mean new money coming in. I'm just saying you sell bonds now to buy more stock. This is the top of the market, right? There's that old adage of when the bottom market's down, you sell out of fear, and when it goes up, you buy out of greed, right? That's buying high, selling low, and you repeat that until you're broke, right?
That is a recipe for non-success.
Exactly. So you want to be careful that you stick to the plan, whatever the long-term asset allocation plan is for the portfolio. You should revisit that. We do that here once a year. But you should revisit that once a year. But the important part is that you stick to that in the best of times, and you stick to that in the worst of times.
Well, that's because when we create these portfolios and manage them throughout these periods of time, we've already taken into account that these market movements that occur, the lows and the highs, they're already considered in these long-term capital market assumptions that we use that are produced by the companies that you mentioned earlier that we respect so well. So when markets are doing well, we don't necessarily take all the credit for having done it perfectly right. When the markets go bad, we don't necessarily need to take all the blame because we've already had that in the portfolio itself in the expected return. So, this is a great way for investors to participate in the movements that we're seeing. I mean, can you imagine having a 96% return in small caps and having had an overweight in them like we had since August of last year? That's good investment management.
Outside of investment management, just the financial plan in general, we plan for the good and bad times, like you mentioned, but unless your goals have changed, you should be sticking to the same allocation. We'll take care of some rebalancing from time to time, but sticking towards that allocation and just focusing on your goals. And if anything's changed, other than that, just maintaining that long-term investment plan as well as just financial plan overall.
I think it's a great point that you make, Matthews, because the financial plan is like the blueprint to a house, right? It gives the contractor something to look at and to build from. And that's the way the financial plan is done here, is that it becomes your blueprint for success for you to have a lifetime, of financial freedom, planning out for 30 years in retirement or more. So these years that we have up and some years that we have down, that's already considered in the portfolio.
Another thing we haven't really talked about as an asset class is real estate. Home appreciation, I guess this is a nationwide number, up 11%.
Yeah, the Case-Shiller report came out, up 11% in the past year. And that's on average. There are pockets in the U.S. that have done very well indeed. Here in Atlanta, it's around just under 10% for the past year. That's to see your home go up 10% in value, creating more equity in your home.
You also have interest rates at record lows. We came off that the official low, I think, last month, but I think it's a great time to be refining the home. Make sure you get that home paid off before retirement. 15-year loan at the most, maybe even do a 10. Although I noticed last week the 10-year rate was higher than the 15-year for some reason. So maybe about a 15-year loan makes a lot of sense right now in this environment. But just thinking about REITs alone, I still feel like that's an underperforming asset class. If you look at how that index is constructed, a lot of it is public storage. It's not as much office space. There's still a lot of office space, but not as much as you would think. And something else I've seen in the news is a lot of these companies saying we're using less office space going forward is spin, because what they're really telling you is they laid off 5,000 employees. So yes, they're use less office space going forward, but they had to lay people off, and now all of a sudden they're using less office space, right? So you have to read between the lines on a lot of this stuff. That I don't think maybe the office space is different, but I don't know. Harvard Business Review has a great podcast out recently about office space and the future of office space, and I was listening to that, and they're talking about more people working from home, but then you don't have interactions with anybody. So then they have to create programming in office. So they redesigned their office space. Maybe it used to be 50 cubicles, but now it's a huge lounge. And so once a month, once a week, whatever it is for the company, they have to come in and have social hour because people don't know each other. You only know the team members on your team, but you're going to know anybody else. And I'm like, man, that's a lot of work. Why don't you just come into the office?
Well, the cultures of a lot of those firms aren't the best anyway, so I think that's probably was going that route regardless of if it was a pandemic or not. But the office structure probably will go away from the people crammed into cubicles. Maybe you won't need every floor of the building, but it'll definitely change the way that the COVID setup is in those common areas in the future.
But again, I think they're still leasing the same square footage. They're just using it differently, right? I mean, because some of the biggest companies to announce that they were getting rid of offices also announced layoffs.
There's a lot in Atlanta too that aren't though, that are just mentioning that they're going to come in the office once or twice a week or a few times a month. So a lot of those jobs are able to work from home. So I think it is the shifting landscape as well, not just the layoffs.
Right. Well, maybe with all these new small growth companies, they'll need an office space. Maybe it all just kind of balances out in the end.
It may. I think we're in a shifting period, I think is a great way of saying it. It may be that offices change. Work has always provided a social outlet for people as well to interact, with each other, to accomplish things together. There'll be some work at home. There'll be some work at the office, and the office environment may change. That's okay. We'll see what happens. To your point, Casey, where companies may be laying off people, they may also be trying to renegotiate with the landlord. Yeah,
true. I mean, right now, Vanguard shows REITs will return 3 to 5% per year over the next 10 years. That's the exact same they have for the S&P 500.
Yeah,
3 to 5% per year. With really underperforming being U.S. growth, outperforming being U.S. value. They're showing U.S. growth, they expect to have a negative 2% rate of return, U.S. value at 6.4% on the high end. So that's interesting, all with similar volatility. So I don't know. I still think real estate has a good spot in the portfolio, whether it be through REITs inside your portfolio or even just buying your own real estate at this point. We've seen an increase in vacation rentals. Even so much so that Fannie and Freddie are talking about having higher interest rates for second homes. That's how crazy it's gotten with second home purchases recently. So anyway, well, guys, this is a good review. I mean, we should do every client review right now and show them 50 to 90% rate of returns on their equities on the equity side of their portfolio. But no, it's fun to see it on the other end. We work really hard in our field when things don't go well. That's when we have to stand the ground and say, nope, this is what we have to do to be successful. And I'll say this, we didn't have one family here go to cash. I can't think of one.
Some discussions, though. So, definitely got phone calls.
Oh, no, there were some discussions. There's no doubt about that.
Calls.
There's a lot of communication, but this is the successful side of being a patient investor and a well-allocated investor. So congratulations to our clients. You guys did it. We still have a long ways to go. 1 year is nothing compared to a 30-plus year time horizon in investing. And thank you guys for your hard work and perseverance during that time period. I couldn't have done without you.
Very welcome.
Thank you.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.